I'm a long-time associate slash friend of Dan's. We met way back in the 1990s when he was on the floor working with Mercury, and I was, full-time at the Options Institute, which I'm sure many of you know is the education division of the CBOE. And it's been a long and fruitful and largely fun relationship, talking about trading and strategies and all kinds of issues that come up. But anyway, all right, so here's the standard disclaimer. I'm not a registered investment advisor or broker. Commissions are not included in the transactions. And of course, there's risk in all this, so you got to be prepared to lose some money if you want to try and make some. Anyway, now here's kind of the things I want to talk about. I mean, the overall topic, of course, is choosing credit spreads. So the first thing you have to do is choose which underlyings you're going to do this on. Are you going to do it on ETFs or individual stocks or indexes or whatever? So then I'm going to talk about that, and then I'm going to talk about actually the important elements of a plan. Because the most important thing about trading is having a plan. I mean, too many people, they say, oh, XYZ is going to have good earnings or bad earnings, or it's going to move a lot. And so they say, well, I'll buy a straddle, or I'll buy a call or a put, or I'll sell a call or a put. Well, I mean, my problem with that approach is that it's not a plan, it's a gamble, okay? And I've been doing this for a long time, and my experience tells me that gamblers come and they flame out and they disappear. I mean, if you can come up with the perfect trading or gambling plan, well, that's different. But in all my years, I've never seen anybody succeed at that. But what I hope to show you today is a plan which takes the gamble out of it. I mean, a gamble is a statistically losing risk, whereas a plan, hopefully, is a statistically profitable risk. I mean, the concept is that you make $10, make $10, make $10, then you lose $8. Then you make $10, make $10, make $10, and then you lose $12. But after a series of trades, you have a net profit. So I'm going to talk about, I mean, the most important part of this, 30 to 40 minute talk is the plan concept. And part of my plan is working from actual price history, okay? And I have a specific way of doing it, which again is not right for everybody, or it's not the best way, it's not the only way, but I'd like to show it to you, and then you take what you like and kind of set aside what you don't think works for you. And then I'm going to show you some real examples based on my plan and my studying of prices. And I'm going to show you 3 trades, 2 of which historically were winners. I mean, they're not at all recommendations or anything like that. And one of them, quite honestly, was a loser. And I think you'll be very familiar with it. It's a well-known example from very, very recent history. But I'm, again, trying to be realistic. All right. So that's where we're going. And then once we go through that, then I'm going to show you some current examples based on my trading plan. Now, remember, these are not recommendations. These are just ideas for you to look at my methodology and see an idea that I came up with. Again, it's not a recommendation. It's just the results of my approach. And if you like it, fine. But if you don't like it, well, have a good laugh and we'll look for another one, okay? So that's where we're going, and like I said, the next half hour or so. Now, when I select underlyings, One of the things is to look for very high-priced stocks. I mean, I'm talking Chipotle, Google, Amazon. I mean, high-priced stocks. And if I had to pick a number, I would say you want to be over a $200 underlying. And the reason is that you can, I mean, if you just use the pricing formula, I mean, if you go 10% out of the money on a $300 stock, you're going to get a much greater credit than going 10% out of the money on an $80 stock. And now, that's a big component of it. It's not the only component, but it's a big component. So I have a list of, you know, high-priced underlyings, and they are the ones that I generally look at, that I look at every month, and I pick my trades in a method I'll show you coming right up. So here are the key elements of a trading plan, okay? You need to pick a time period. You know, I mean, we have options that expire weekly, but I would not suggest that. That becomes more, in my opinion, more of a gamble than of a plan, okay? But, you know, 1 week, 1 month, 2 months, these are some very standard time periods that people pick that can work positively for you over time. Then you need to pick a spread width, okay? And of course, most underlyings, you know, they have, I mean, again, some items have got 1 point spreads, but again, you know, generally you want a wider spread. And then every month or whatever your period of time is, based on your trading plan, you have to pick a quantity of spreads. And the quantity of spreads that you can trade is, well, it's absolutely limited by the amount of trading capital you have. But one of my big things is never maximize your margin, never use up all your capital. And I'll go into that in more details as we go through it. But that should be part of your trading plan. I mean, just because you have a lot of money doesn't mean you want to do a lot of spreads. So we'll talk about that as we go through it in my quote, current portfolio, unquote. All right. Now, here are my answers. Now, again, this is not right or wrong or better. It's just my answers. And maybe you want to do it differently. But the way I do it is I do it 5 weeks before an expiration. Okay? So like today when I'm giving this webinar is Friday, November 17. And last Friday, November 10, that was 5 weeks before December 15 expiration. So it was last weekend, November 11 and 12, that I did my analysis for December expiration, and I picked my trades and I put them on Monday morning, November 13. Okay? But anyway, here, my answers to the question are that I have a 5-week time period. Now again, that's not theoretically correct or statistically better than any other time period. It's just the time period that I have become comfortable with and I've fallen into a pattern of doing, and it works for me, so that's my answer to the question. And then my spread width, and when I'm in my current portfolio, I'll show you that I look at spreads that are a minimum of $2. Typically, though, I mean, the vast majority of times I do 5-point wide spreads, okay? And again, this is not right or better than any other approach. It's just what I have fallen into, and I'm comfortable with it, and it works for me, so I just keep doing it, okay? And then I try and do at least 5 spreads every expiration, and sometimes I'll do a little bit more. I'll do 6 or occasionally 7. But generally, I'm in that, 4, 5, 6, 5-point spreads per month. So that's what I do. Now, for this example and the current portfolio I'm going to show you, I have a capital assumption of $10,000. And I realize that those of you listening Some of you have an account that is smaller than this, and some of you have accounts that are much, much bigger. But 10,000 is very good for an example because you can scale it up or you can scale it down. There were actually some summer interns a few years ago at the CBOE. They've now graduated and have jobs, and I'm still in touch with two of them, and they don't have $10,000. One of them has got 4,000, and the other has, I don't know, 6,500 or something. But the point is, they can do this strategy and this approach, this trading plan, with that amount of capital. Okay, and the goal is to make a high percentage return on your capital. And having a small amount of capital is not, it's not a fault. It's just you have to plan for it. And if you're fortunate enough to have more capital, well, you still have to plan. You can't get sloppy and careless and all that other stuff. So that's where we're going here. Now, my plan is I put a spread on, and I hope to hold it to expiration. But if the stock starts to move against me, now this is meant to be a little bit of a humorous statement. I close it out when the pain is too great. And I'm going to talk more about that when I get to the current examples. But it's not just a pain element. It's also a market view element. Sometimes, as we all know, a stock or an underlying will have a very, very sharp move. Now, it might be because the whole market is going up or down. But I then look at the chart and I say, this stock has shifted direction and it's now in a sustained uptrend or downtrend. And that causes me real concern about my credit spread. So because of my change in market opinion, I will just close out the spread. And sometimes I close it out, with a pretty substantial loss. And sometimes I close it out at break even. And occasionally I'll close it out, at a profit. It could be a small profit or it could be nearly the whole thing. I do not have rules about closing a spread out, for a nickel. A lot of brokers let you close out a short option. You can buy it back for less than 10 cents or less than 5 cents for zero commission. Okay. But if I've got 3 days to go and an option is still $20 out of the money and there's no earnings report, and I don't think there's any reasonable chance in the world that this stock is going to move that $20, then even though the option is 5 cents, I'll say, just let it go. I'll live with it. Okay. Now, you might not share that opinion, and you might feel more comfortable closing it out, and that's perfectly fine. There's no absolutely right or wrong. That's why I have the term totally subjective there. If I sell a call spread on a stock and the day after I sell that spread, the stock starts going down, well, I feel pretty good, and I'm highly, highly likely just going to carry that credit spread expiration. But it's not always the case. The stock might turn around, circumstances might change, but anyway, that's the concept, okay? So when I open a credit spread, my goal is to carry it to expiration, but I'm watching it, and I might change it based on a totally subjective thing. Could be price action, could be pending news, could be something, who knows. So let me give you the first of 3 examples. Now, I went back, and this is Qualcomm. Again, it's not a recommendation. It is strictly a historical example. But I went back to September of 2015. So during the 5-week period from sometime in September to October of 2015, Qualcomm, high to low, had a $7.76 range. Then from 5 weeks, November to December, it had a $6.12 range. And then in January, it had a $4.87 range. Now, I'm not going to read all these to you, but as you can see, the average 5-week period for these 10 5-week observations was $6.60. Okay? Now that is accurate information, and I got this, my own analysis, from TC2000. I assume many of you or most of you are familiar with a charting service provided by Warden Brothers called TC2000. They also have an excellent service called freestockcharts.com, and I kind of go back and forth between Free Stock Charts and TC2000. TC2000 does cost money, so you should inquire at Warden Brothers to find out how much it is, what periods are available, and whether or not you want to spend that money. Okay? And I will warn you that freestockcharts.com requires a Microsoft add-on to your computer called Silverlight. I mean, so does TC2000, by the way. But anyway, some of the web browsers like Firefox and I think Chrome, they have stopped supporting Silverlight. So I've heard numerous problems. In fact, I've had it myself on my second computer, getting Free Stock Charts to work on my second computer. For whatever reason, Firefox, it doesn't seem to work. So I've had some issues. I've got to call them and see if I can get that resolved. I don't know. So just be aware that there might be a technical issue with freestockcharts.com. Again, I'm not a computer expert. I don't know anything about it. But if you're interested, if you can get it to work, it's an excellent service. And free is always a good price, of course. But anyway, so going back to this example, Qualcomm, during these 10 5-week periods, had an average range of $6.60. Okay? And so to complete the example, now the 5-week periods isn't the only thing you should look at. You should also look at how much the stock moves on an earnings announcement. Okay? So in January of 2016, earnings came out on January 25th, and the stock went up $1.90. Then in April, stock went up 32 cents. Then in July, it went down $1.17. And on 11/1, well, that was a big move, up $3.75. Okay? So the average of these 4 earnings moves was $1.78. Now, that gave me confidence. I might have to go ahead and back a slide here. Hold on. Okay, here we are finishing up the Qualcomm example. Seeing an average price range during 5 weeks of $6.60, and then seeing an average of $1.78 on earnings moves, that gave me confidence to sell an option 8 points out of the money. Okay? Now, I don't remember how much money I got. I mean, Qualcomm has $2.50 strike prices. So maybe I got a quarter, maybe I got 30 cents, approximately 10% of the spread range is what I look for. Okay? And then, now again, I said I was going to give you 2 profitable examples and 1 losing example. So this was perfect. I mean, the stock during this 5-week period from November 11 of 16 to December expiration, the stock hardly moved. It went literally down 40 cents. So if I sold a call spread out of the money or a put spread 8 points out of the money, it obviously expired worthless. I mean, that was as perfect an example as you can get. And this is a historical example. It's not a recommendation. And believe me, they're not all like this. Okay? But look at the logic. I had an average range of 660. I had an average EPS move, earnings move of less than $2. So I felt very comfortable selling a credit spread where the short strike was 8 points away from the current stock price. Okay? That was the logic. And again, this is a profitable example where it worked. So let's go to the next example. This is Tesla. And I go through this is a similar late 2015 to 2016 example. Okay? Now Tesla, if you look at this, it had an average 5-week range during these 10 observations. Had an average weekly 5-week range of $46. So obviously a much more volatile stock than Qualcomm. I mean, it's higher priced, you know, $300 a share or whatever. And but I mean, so it's obviously much more volatile, right? Okay. Now go to the next page. Now this is the second half of the Tesla example. Now there were 4 EPS moves that had an average of $10.02. The average stock price range was $46.29. Well, that gives me a comfort to sell a spread that's 60 points out of the money. Okay? And since Tesla actually did have one movement during that 15, 16 year period that was over $60, I mean, even though you sell something 60 points out of the money, I mean, there is a chance that could be a losing trade. So you would feel comfortable doing this by this approach, but that doesn't mean it's guaranteed to work out. I mean, you bring in 50 or 60 cents credit. I mean, you could lose on a 5-point spread, $4.50 or whatever, if that stock moves more than the 60 points. So there's real risk here, but this is the logic for choosing the spread. Okay, so this is example 2. Now, the minute you see the next example, you're going to know where I'm going. Okay, but the next example is, hold on to your hats, it's Amazon. And of course, you all know where this is going, right? But Amazon, now again, this is a recent trade. So I'm going to look at 2016, late 2016, September of 2016 to October, and then October, November of 16. But then we get into this year. So this is, you know, January to February of 17, you know, February to March of 17, and all the way through 2017. So here is, again, a very high-priced stock, you know, now $1,000 bucks. But here's a stock that during the last year has had an average 5-week range of $69. Now, to complete this, we're going to also look at the earnings moves. Now, you're going to see all this. But so Amazon had an average earnings move of $32.73. And it had a 5-week range of $69. So they're kind of in the middle of the screen. It's logical to feel comfortable selling a spread that is 90 points out of the money. Okay? So if I could sell a spread 90 points out of the money, I mean, I would feel very comfortable. You know, I know there's risk, but I would feel comfortable doing this. Well, lo and behold, Amazon reports earnings, and it jumps $128.69. And so my spread, my $5 spread that's $9 out of the money, $90 out of the money, it goes to maximum value, and that is definitely my loser. So that is definitely one example where this approach did not work, okay? But we see the logic. I have a lot of history. I know how the last earnings moves were, and I felt very comfortable selling an option 90 points out of the money. But anything can happen, so didn't work. Bad trade. All right. Now, so let me go through some current ideas. Now, these are prices as of last Friday, November 10th. And again, these are not recommendations. These are just ideas showing you, my thinking, okay? But like Tesla was at 303 or 302.99 if you want to be particular. And my my analysis was that the average range over the previous year, the 5-week periods over the previous 10 or 11 months, was $38.70. Okay? And the earnings on Tesla, they had just reported earnings, I guess, I'm not exactly sure when, late October, early November. So the next earnings report is not due until February 20. Okay? So I don't have to worry about earnings before December 15, the next option expiration. So I feel comfortable selling the 340, 345 call spread. And if I can get, which I did, get 60 cents for that, or $60 per spread, okay, that's the kind of trade that this approach leads you to. Now, my second idea, based on this analysis and approach, is Chipotle. Chipotle closed at 273 and kind of had an average range of 26, but Chipotle is a very volatile stock, and it had one of those 5-week periods, it had a $40 or $45 price range, so it's definitely a mover. But anyway, this leads me to selling a put spread, the 245, 240 put spread on Chipotle, and you could do that for 50 cents. And then Lockheed Martin, LMT, might be a stock that many of you do not follow, but again, it's a very high-priced stock, and it's got pretty high volatility. I mean, the average range is only $12 by my analysis over, each 5-week ranges over the last year. And the earnings, again, don't come out until late January. So I felt comfortable selling the 325, 330 call spread. And Lockheed Martin, when I looked at that spread, it was like 55 cents bid offered at 80 cents, or maybe even 85 cents. I think it was 55 cents bid at 80 cents. So I offered it above the 55 cent bid by a nickel, offered it at 60 cents, and I got filled at 60 cents. Doesn't always happen, of course, but you try and squeeze it, make a little bit extra if you can, okay? And its earnings don't come till January 24th, so again, there's no earnings worry. Now, here's another one that a lot of you probably haven't thought of, perhaps, and that's one of the sector spiders. XLY is the consumer discretionary, sector ETF. It was trading at 92.37 last Friday was its closing price, Friday, November 10. And over the previous year, it had a 5-week average range by my analysis of $1.85. And of course, the sector ETF doesn't report earnings. Maybe a lot of the companies in the ETF will cause earnings, and arguably if enough of them move, then you know, it could move the sector ETF, but not a big concern for me here. Okay, so if you add up all these trades, $60, $50, 60, 60, and then 100, because we're doing 4 on the XLY. Okay, we're bringing in a total of $330 total premium. Okay, now just to look at that XLY for just a second, just on a pure percentage basis, 25 cents on a $2 spread is actually a greater percentage than $50 on a $5 spread. So part of it is you want to try and get more than 10% of the spread width. It's not always possible. I mean, even on, the Amazons and Googles and Teslas of the world, it's not always possible. But that at least is a starting point to look for. All right. So now the next thing is to manage our margin. So looking at the next slide here, I'm going down each of the spreads. The Tesla call spread, 5-point spread, requires a margin requirement of $500. The Chipotle requires $500. So each of my 5-point spreads, the first 4, require $500, which is $2,000 bucks. But the 4 XLY spreads, they only are $200 each. So that is $800 total. So these 5 positions have a total margin requirement of $2,800. Now, this repeats and reinforces a point I made much earlier. I'm only using $2,800 of my $10,000 sample portfolio. So the message is keep a substantial amount of your capital in reserve. And personally, I do this. I mean, I rarely use more than half of my margin. Okay? But as you develop your comfort level, I mean, I would suggest that you start, with 1/3 to 40% of your capital, and then you have a number of profitable months and you feel your confidence building, well, then inch that up to 50%. And after a few more months and a few more successes, inch that up to 60%. And I personally don't know anybody but overly eager and aggressive novices who use all of their capital when doing this strategy. And those people typically have problems and end up giving up trading, sometimes after 6 months, sometimes after a year and a half. Okay? But the point is that $330 is still more than 10% of your margin requirement. And that's another part of my trading plan. The goal is to make a very high percent on the margin at risk, or the margin requirement. Okay. Now, conceptually, if you could make 50% on 50% of your capital, well, then that's a 25% return on all of your capital. And, that's part of your plan. I mean, if you can make 10% on your margin every month, and there's absolutely no guarantee that you can do that, but if you could, and let's say you used 1/3 of your capital, well, then you're making 3% on all of your capital every month. And over the course of a year, that's a very impressive, attractive return. And that doesn't matter whether you have 5,000 in your account or 50,000 in your account or more. It's the planning and the thinking that leads you to a consistent strategy. Okay? So that is the name of the game. Now, again, feel free to submit any questions if you've got them. Only got a couple of more slides here. Actually, this is pretty much my last slide before I totally open it for questions. I mean, I really would advise you, don't just look at the chart and say, oh, look at this, it's traded between 40 and 50. It'll never go to 60, so I'm going to sell the 55 call. Well, you could have done that on Amazon last month, and you would have been burned dramatically. And you see, people's recollection and eyeballing of charts really is sloppy, and it's very unspecific, and nobody has that good a memory that they can remember everything. So please, take the time to write the important stuff down, and have a file in your desk or a pad of paper, wherever you work. Have something that you can go back to and look at. It really builds your confidence, and it makes your trading very specific. Yes, you're still going to have your losers. Yes, you're still going to have your issues. But I believe that concrete information leads to greater confidence and better decision making. Now, after having said that, you can do all the analysis you want, and you can write down all the information you want. When you're all done, you'll probably have information on 10 or 15 or more stocks, or underlyings, depending on how much you write down. And then you have to go back and say, wow, I've studied these 22 underlyings. Which options should I do? With my capital, I can only do 4 spreads, or I can only do 6 spreads or X spreads, or however many spreads you can do. Well, then you can't do them all. You've got to choose. And that's where the art comes in. And so you just be careful. Now, the third thing on this line is sell spreads way out of the money. I mean, if average price range for a stock is $10, I mean, look at the spread that's $12 to $15 out of the money. I mean, there's no guarantee that this particular month the stock won't move $20, but at least you've got a lot of information, and based on history, $15 is way out of the money. Okay? I mean, I'd rather get 30 cents for a spread where I have a very, very high level of confidence than getting 70 cents for a spread that I just can tell is a gamble. And that's another reason I stay away from earnings. It's because earnings, as we saw in Amazon and numerous other cases, can really mess up the whole thing. Well, those are my big conclusions. Some of you are moving average followers, and I mean, if the stock has just gone above a moving average, I mean, some of you watch the 25 days, some of you watch the 50-day, I don't know. But if a stock has just made a high volume move across a moving average, then if it's moved up across the moving average, I would be more inclined to sell a put spread. And similarly, if it has made a high volume move below the moving average, then I would be more inclined to sell a call spread. I mean, I definitely stay away from earnings. I mean, earnings overshadow anything. I mean, if you're a technical analyst and you see a double top, well, if earnings are day after tomorrow, that double top doesn't mean anything. And similarly, if you have a very, very high volume move across a moving average, but the earnings announcement is in the near future, well, under normal circumstances, that high volume price move would be pretty significant. But with earnings coming up, that throws everything out the window. So that's my approach. That's the art part of the business. I pay attention to charts, but I don't have any detailed rules about that. I pay attention to moving averages, but again, I don't have any concrete rules that I can advertise to you, or high percentage winners. Okay, that's where the art part of the business comes in. Okay.
Sure. Appreciate that, Jim.
Yeah. Now,
we got another question. Weeklies or monthlies? Do you do just the longer term trades, or do you ever dabble in the weeklies?
Again, there's no right or wrong answer to this. There's no scientifically correct answer. But I use a 5-week time period. So last week, November 10th, was 5 weeks before December expiration on December 15th. So last weekend, I did my analysis, chose my trades, and I entered them all on Monday. And then December 15 is 5 weeks before January expiration on January 19th. So that weekend, December 16, 17, I will be picking my January trades. Now again, and about this profit of $60, remember, the credit you receive is your target profit. It's not your profit. It's just the upfront credit. If you end up buying that spread back for more than $60 or 60 cents, then it's going to be a loser. But yes, I shoot for 10% of the spread width as my target credit. So if I'm doing a $5 spread, I want to get at least 50 cents. And on these underlyings that you saw in my example, you frequently can get 55 or 60 cents. Occasionally, you can get more. I just did a $5 spread on some stock that was way out of the money, and I got over 70 cents. I forget, 72 or 74 cents. So 50 cents is kind of my minimum personal benchmark. If the spread is 30 cents bid at 55 cents, well, I'll probably just ignore it. The midpoint is kind of your starting point, but I frequently, like one of these spreads, like that Tesla spread, I think it was 55 cents bid at 80 cents. And so where's the midpoint on that? Close to 70 cents. But I sold it at 60 cents. It was still better than the bid of 55. But, maybe I could have squeezed it. Maybe I couldn't have. I don't know. But I just was thinking at the time that 60 cents was pretty good. So we got another question here. I don't really focus on the delta. The delta is another useful tool to give you a estimate of the probability of the trade winning or losing. But remember that the delta kind of depends on the level of volatility in the option. And the implied volatility, of course, is determined by the forces of supply and demand in the market. So the delta of the option is actually a market-determined number as well. And it's generally very good. If you believe in the efficient market, which I tend to do, then it's an excellent estimate. It's not guaranteed, and just remember, if something has a 10% chance of happening, it could happen. If something has an 80% chance of not happening, it's got a 20% chance of happening. And if you do this a lot, then you're going to have those rare events happen from time to time. It's really weird, but at your summer seminar last summer, Dan's Chicago seminar last July, I kind of reviewed my results for the previous year, and I was selling a lot of 15 delta options, or the short option in the spread was 15 deltas, and it was really funny. But I had, well, in theory, I should have had 15% losing trades. It turned out that I had 19 or 20% losing trades. So the strategy was still profitable over the 12 months, but I did have that 19 or 20% losing trades. So that's an example where the delta was an excellent estimate of, you know, how often you're going to lose. Okay? Well, that pretty much wraps it up for me, Johnny.
Yeah. No, we appreciate it, Jim. Thanks for coming on and sharing today. If you guys do have any other questions, go ahead and email them to us at info@SheridanMentoring.com, and we'll definitely make sure to send them over to Jim.
Okay, bye-bye, everyone.
Bye.